Friends, hope you're well. Welcome to another video in our series Finance and Investing Tidbits. We have a very interesting video today. Why does the balance sheet balance? We can paraphrase this question in another way and say, why don't we call it as unbalanced sheet and rather a balance sheet? I'm just joking. Welcome to the video. We all know that businesses use different types of resources. They include equipment, office space, materials, talent, and so on and so forth. Now, since a firm is an entity with its own existence being separate from owners, having been incorporated as a limited liability company, every resource needs to be financed, partly by way of equity and partly by way of borrowings. After all, a company can't print its own money. It has to use money which is already the authenticated money in circulation. So it has to rely on these two sources of finance, equity, and debt or borrowings. Profits of the firm also add up to the sources of funds, being a part of the equity itself. Equity is the money put in by investors, and after they put in their starting money, every profit gets accumulated as a part of the equity itself unless it's distributed. Thus, the total of all the resources owned by the firm can be all explained by the sources of funds together, which has to be either equity or debt. Now, we can of course think about people who indirectly finance a business, which are the vendors, the employees, the customers who pay advances, the government which gives you time for paying taxes, and that can also be called as liabilities. Thus, equity plus liability together finance all our resources or assets. Thus, resources owned by the firm, which are called as assets, are financed by sources of funds which are equity and liabilities. Thus, equity and liabilities finance assets and therefore they must be equal to assets. Assets are equal to equity plus liabilities, and thus we can have this basic equation among these two, and therefore there is a natural balance between assets on one hand and equity and liabilities on the other, the resources on one hand and the sources of funds. The statement which captures equity, liabilities and assets is called as the balance sheet, not just because it balances in terms of equality, but also it reports the balances or stock of equity, liabilities and assets, and therefore also it is called as the balance sheet. The accounting process which takes into account give and take, which are equal and opposite. So when the transactions are recorded, the give and take is also taken into account, and as a result, because there is an inherent balance in give and take, when each of these transactions are recorded in this fashion, there is a natural balance across various accounting heads which are used to record these numerous transactions. And that is another reason why when we actually cull the balances of various assets, equity and liabilities out to have a review and for preparing financial statements, we see an inherent equality. Both these reasons ensure that the balance sheet balances, and we have no reason to call it as unbalanced sheet. We call it as balance sheet, it balances. Thank you.